Hi, everybody, and welcome back to video 4 on Chapter 3. Here we're going to take a look at the stockholders' equity when we last looked at the Off-Brand Incorporated's balance sheet. And here you can see that they have reported stockholders' equity here. Whoops. Stockholders' equity here. Common stock, retained earnings, and then accumulated other comprehensive income. $100,000. Okay, so let's put it into practice a little bit. As it says, the facts with the Quinton Incorporated, they had retained earnings of $375,000 at January 1, 2025. And then during 2025, they reported net income of $1.7 million, declared some dividends, and paid them to the tune of $85,000. An error was discovered. Land costing $80,000 net of tax was charged to maintenance and repairs expense in 2024. Ooh, not good. Anyway, the instructions were going to prepare a retained earnings statement for the year ended December 31, 2025. So you can see here, here's our beginning retained earnings, 375. Right away, we're going to correct the overstated expenses in the prior period net of tax. So 455,000 adjusted January 1. Then we add our net income to that. We subtract our dividends from that, and we get our retained earnings. Pretty straightforward there. Okay, let's take a look at the revenue recognition principle. And here, we're going to recognize revenue when they are generally earned. And to recognize revenue, it depicts the transfer of goods or services to customers in an amount that reflects the amount of money, consideration, that the company receives or expects to receive in exchange for those goods and services. So you will see that it's not necessarily, as I'm sure you know, when we receive the cash. The company recognizes revenue when its performance obligation, that's when the customer takes transfer of title to that good or service. And that change of control is the deciding factor in determining when that performance obligation is satisfied. Okay, when has control passed? There's some examples here, indicators. The company has a right to the payment for the asset here. The company has transferred legal title to the asset. The company has transferred physical possession of the asset. The customer has significant risk and reward of ownership here, and the customer has accepted the asset. Now, this is a list of indicators, not necessarily requirements. The FASB has developed a 5-step model for recording and measuring the amount of revenue to be recognized, all of which mean that the revenue has been earned. Let's take a look. Step number 1, we are going to identify the contracts with the customer. This is a contract. It's an agreement between two parties. Boeing has signed a contract to deliver airplanes to Delta. Number 2, Boeing has only one performance obligation, and that's to deliver those airplanes to Delta. If Boeing also agreed to have separate maintenance, then that's going to be recorded as a separate promise. Then in step 3 here, the transaction price is the amount of money that has been agreed upon between Delta and Boeing, in this case, $100 million. So in step 4, we're going to allocate the transaction price to separate performance obligations. In this case, though, Boeing only has one performance obligation, and that's to deliver those airplanes to Delta. And then in step 5, we're going to recognize the revenue when they deliver that airplane to Delta and satisfies its performance obligation. Okay, let's go through it. We're going to identify the contract. Here, FedEx, for most of our contracts with the customer contracts with us to provide distinct services within a single contract, primarily transportation. Ford, revenue is recognized when, under the terms of the contract with the customer, is satisfied. So this occurs when the transfer of control of our vehicles, parts, accessories, or services has occurred. Normally, that's not to the end customer, that's to Ford Motor Company's dealer. Okay, validity of the contract. Revenue is recognized only when a valid contract exists. For a contract to be valid, it must meet the following criteria. 1, approval and commitment of both parties. 2, identification of the rights and payment terms and commercial substance. And the contract represents a valid transaction. And 3, collection is probable. So revenue recognition begins with the existence of a valid contract, whether written or implied. In the case of accounts receivable, we don't have a written formal agreement, or for that matter, with our accounts payable, but there is an implied contract. All right, here let's look at an example. Flex Company sells equipment to a customer for total consideration of $1 million to be paid in annual payments at the end of the next 3 years. While Flex Company hoped to generate a lot of business with this customer, there is some uncertainty about whether the customer will be able to pay as those amounts become due. Flex Company delivers the equipment at the inception of the contract. At the end of the first year of the contract, the customer indicates it will not be able to make the first payment. Flex Company then determines collection of the remaining amounts is not probable. Not probable. Okay, can Flex Company recognize revenue on this contract? And the answer is no. Flex Company cannot recognize revenue. Even though it's a valid contract, all the criteria has been met, collection is not probable. Therefore, Flex Company cannot recognize revenue until that payment is probable. Only then, or when the payment is received, can Flex Company recognize revenue on that contract. Okay, so identifying performance obligations. Here we have some situations with Microsoft and Activision Blizzard. Activision Blizzard, if you're not familiar, does gaming and that kind of thing. So it's going to recognize its revenue, Activision Blizzard, when it is recognized revenue that includes a significant online functionality, such as Call of Duty franchise. So a little bit different in the way that they earn their revenue, but they both earn their revenue in different ways. Okay, performance obligation example. Zoom Amazon sells a fitness tracker for $36. Included in this price is a warranty, which covers any repair costs to the fitness tracker for 1 year after purchase. Does Amazon have 1 or 2 performance obligations related to the sale of the fitness tracker? Okay. It has only 1 performance obligation. That's because the warranty promise, referred to as an assurance warranty, cannot be separately identified from the sale of the fitness tracker. While both the fitness tracker and the warranty are capable of being distinct, and the customer could benefit from each item on its own, the warranty promise cannot be separately identified from the fitness tracker within this contract. Okay, determining the transaction price. Here, Nike and Amazon measures their revenues. And I'll let you read that on your own in the book, of course. And so let's look at variable consideration. This is going to describe a situation in which the price of the good or service is dependent on future events. Pretty common. Future events might include price increase, volume discounts, rebates, credits, performance bonuses, or royalties. Now, the companies estimate the amount of variable consideration they will receive from the contract to determine the amount of revenue to recognize. They commonly use what's called expected value, and that's a probability weighted amount. So let's see how they do that little beauty. Here's an example. Peabody Incorporated enters into a contract with Doolittle Company to build a warehouse for $100,000 with a performance bonus of $50,000 that's going to be paid based on the timing of completion. The amount of performance bonus decreases by 10% per week for every week beyond the agreed upon completion date. These requirements are similar to contracts Peabody has performed previously, and management believes that such experience is predictive for the contract. So, Peabody concludes that the expected value method is the most predictive in this case. It estimates that here, bullet point 1, 60% probability is going to be completed on the agreed upon completion date. 30% it'll be a week late, and 10% it'll be 2 weeks late. How should they cover this transaction? All right, so here is the 150,000. Go back here. Here's the 100,000 here and the 50,000 here. Okay. And we're going to assume that 60% of the time we're going to get full performance. 30% of the time we're going to get less than that, and then 10% of the time we'll have that. You'll see that this is dropping by 5,000 per week. Okay, so we multiply these through and we get 147,005 based on the probability weighted estimate. Peabody is going to update its estimate each reporting date. Okay, did you see that? Let you look at that for a second. Don't forget that decreases by 10% per week for every week. So 10% is going to be that $150,000, and the performance bonus is $50,000. So 10% of that's 5,000, and that's the difference between 150 and 45 and 40. 10%. Okay. Now, how we allocate the transaction price. I think that's a good place for us to stop this video. And when we return, we'll take a look at how we allocate that. Until that time, bye for now.